Good afternoon, everyone. On behalf of Centrum Broking, I welcome you all to the Q4 FY18 conference call of Tata Metaliks. We are pleased to host the senior management of Tata Metaliks today for this call, and we have with us Mr. Sandeep Kumar, the MD of the company, and Mr. Subra Sengupta, the CFO. We'll start with initial comments from the management about the quarter gone by and FY18 and the general outlook, and then we'll open the floor for Q&A. So now I'll hand over the floor to Mr. Sandeep Kumar. Over to you, sir.
Yeah, hi. This is Sandeep here. Good afternoon. Along with me is Shubro, our CFO. So thanks, Abhishek, for the call and welcome to all the analysts. Well, the results have been declared, and I suppose you have the press release and the numbers with you. If you look at the overall performance, well, the quarter 4 has been quite good, considering the fact that raw material prices have been raining in only in one direction over the last few months, particularly coal, coke. Even iron ore, there was a major impact in Odisha because of the Supreme Court judgment, leading to closure of a number of mines and a cut in production of almost 20-25% in quarter 4. So that impacted the iron ore prices, which jumped by 50 to 70% in quarter 4. Other than that, I think the GST issues in the middle of the year continue to trouble us. I would say trouble the DIP industry, the ductile iron pipe industry. But in quarter 4, things started getting eased out, and we could see some pull towards the end of quarter 4 towards completion of projects. So all in all, if you look at the numbers, the pig iron sales at 71,000 tons versus 31,000 tons of last year and 65,000 tons of DI sales compared to almost similar numbers in quarter 4 of last year. So this is on the sales volume. And if you look at the EBITDA is more or less the same, about 18.2% in quarter 4 of FY17. Compared to that, it's about 17.8% or close to 18% in this quarter. Though EBITDA as a percentage marginally came down because of the huge implications of the raw material costs going up, but which could not be passed on, particularly to the DI pipe industry. But we believe as we go forward, things are becoming better with some downtrend in the raw material prices and uptick in the DI pipe prices. So, but all in all, I think our strategy of controlling our coke this year by tying up with Tata Steel for long-term, on a long-term basis, that helped us in controlling the coke costs, because out of our total consumption of coke, 40% was already on captive basis. We tied up another 40 to 45% with Tata Steel on long-term basis, which was linked to more on coal price than on coke. So that helped us significantly in improving our spreads in quarter 4. Where we got hit was on ductile iron pipe side, where we could not pass on the prices to consumers, because as you know, the business of ductile iron is more stable. The prices don't fluctuate in line with the raw material prices, and also because of the tremendous pressure and the stocks being carried by the industry after the GST. So that is, overall the performance. I'm not talking too much on numbers. I presume you already have that. As far as the strategy is concerned, we have, reached 100% capacity utilization, in fact, crossed that already. And going forward in FY19, we don't have much capacity to expand into, but we are debottlenecking and trying to improve on whatever more availability we can get, both on pig iron and ductile iron pipe. As far as long-term strategy is concerned, that's well on track. Though we have not announced anything formally, but we are close to finalizing the projects, and statutory clearances are already moving, and even our board clearances, etc., are on track. So as soon as we have these in place, we would announce that. So this is all from my side on an overall basis, and I'm open for questions now. Thank you.
Sure. Thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Bhavin Chadda from Enam Holdings. Please go ahead.
Good afternoon, sir. Good set of numbers. Sir, 2-3 questions. First, on the coal contract which you have with Tata Steel, and you said it is linked more to coking coal than to coke. Do you follow your monthly pricing, quarterly, annually? If you can give some clarity here.
You mean the pricing on coke?
So the Tata Steel contract where you said that the Tata Steel is supplying you coke and your price is more linked to coking coal. So do you adjust this prices on a monthly basis? Because coal prices are also very volatile. So just to know how our spreads would shape up in future. So this contract is adjusted monthly, quarterly or yearly?
Yeah, so it is basically adjusted on a monthly basis.
Okay.
So it's linked to an index.
Right.
For example, Platts is one of the well-known indices.
Right.
Okay? So because we have to be at an arm's length with our parent.
Right.
Okay. So they had excess capacity.
Right.
And we were buying it from the market. So it was a good, win-win for both. They could increase their capacity utilization and we could get it at a cheaper price than the market. At least we have been getting cheaper unless the coal and the coke numbers turn the other way around. Otherwise, if you link it more to coal, what happens, you are relieved from the volatility in coke prices. You are only linked up to the coal volatility. And that also we have plans to manage the coal volatility through hedging. So this year we would be doing coal hedging, which will be linked to our finished good prices. And to some extent, so we will be gradually beginning it from this quarter itself and going forward increasing the hedge. So idea basically being to manage the coal and coke prices, and link it to the finished good prices so that we are not taken by surprise by the volatility.
And my second question is on the DI pipe industry. So what kind of industry is seeing the volume growth and how much is Tata Metaliks outperforming, underperforming on the industry volume growth, and what do you think of next 2 years? Because we hear that the government contracts here all the state governments are doing a lot of work on the water segment. So the industry is expected to go in double digits if you have some view from your side.
Yeah. The pipe industry, the ductile iron pipe industry has been growing at an average CAGR of say 12%. So I would say even if you take a conservative basis of 10%, we see that FY19 there is a strong pull from various state governments in terms of the projects that are announced. Now, even if we take a fraction of those announcements coming into picture actually, we would easily have a growth in excess of 10%. But if you look at FY18, we had estimated a similar growth of 10 to 15%, but in reality the growth was only 5% in FY18. And that was mainly because of the GST. And I am sure you are aware of the GST implications.
Sure.
That the pipe industry earlier was excise duty exempt. So there was a lot of confusion as to who will bear this additional 18%. And that impacted almost the entire industry, which now being sorted out should not have a problem in FY19. But I also must tell you that in FY18, though the pipe industry grew only by 5%, Tata Metaliks grew 15%. And we increased.
Hello?
Participants, please stay connected. We seem to have lost the line for the management. Please continue to hold while we reconnect the management. Thank you. participants, thank you for patiently holding the line. We have the line for the management reconnected. Over to you, sir.
Yeah, sorry, the line got disconnected. So I was saying that the ductile iron pipe industry in FY18 grew only by 5% because of the GST implications. However, Tata Metaliks grew at 15%. And if you look at it, the growth of 15% is of course on the sequential basis in terms of year to year, but in terms of market share also we grew from say 10-11% to say 13%. So I think overall the capacity utilization is more than 100%. So I think overall it's been good, and FY19 onwards, I think from a market pull point of view there should not be a problem. The problem that's going to come for us is to make available the additional capacity, and which in FY19 we are going to have some capacity available through debottlenecking, but most of it would come only after say 2 years or so, once the new projects kick in, about which we have not formally announced as yet.
Yeah. Thank you, sir. Yeah. Hello?
Yeah.
Yeah, thanks a lot, sir. Yeah.
Yeah, right, thanks.
Thank you. The next question is from the line of Rukun Tarachandani from Kotak Asset Management. Please go ahead.
Hi, good afternoon.
Good afternoon.
Pig iron prices have been increasing over the past few months. So if you can just help us understand the demand-supply scenario, specifically in the foundry-grade pig iron, and correspondingly, how sustainable is this price increase from a spread perspective?
Okay, so the pig iron prices have moved up over the last few months in line with the increase in coke prices. Okay, so the two follow the same trend. However, the spreads for us in Q4 were the highest, mainly because of two reasons. One is that we were able to control the cost of coke much better than maybe some of the others. And the other is that we sold selectively more in markets of our choice. But there was also another reason, which was that NINL Nilachal Ispat, which is a major supplier, of course that's not a foundry grade, that's mostly basic grade, only some amounts of foundry grades and intermediate grades it supplies, that was out of action for, most of last quarter. So that's going to impact, that also helped in pushing up the prices. But we have compared that, our spreads were much better on account of these two reasons. One is that we were able to control the cost of coke. So our coke buying was better than the market because we...
Hello.
To that, our coke costs were much lower. And on the market side, because of NIL not being there, the prices went up a little more than what they would have normally got.
Understood. And this NIL going out, is it just a temporary shutdown, or this is to stay for some time according to you?
No. So NINL will come back in May, in the month of May. So more availability will be there. However, there are two factors which may impact. As you know, Sesa Goa had its mines taken back by the Supreme Court judgment in Goa. So Sesa Goa will be short of ore. I understand that most of their requirement of iron ore is met from their captive source, which is now down. So they would have to buy iron ore from Karnataka or from Chhattisgarh. Both ways, the cost of iron ore for them is going to go up significantly. That is my assessment. I mean, you guys would know better. In which case, the market is going to be supported because Sesa is a major player, a bigger player than Tata Metaliks in pig iron. So that would also support the market. Though NINL coming back, mostly with basic grade, would certainly, take care of some of the supply losses which might happen because of Sesa's loss of iron ore availability.
Understood. And finally, if you can just help us with the gross profit per ton on pig iron, if you can help us on the last quarter.
Gross profit per ton. Okay, just 1 second. This is... so you want EBITDA per ton or what?
Okay, EBITDA is also good.
See, so you want the percentage?
No, the absolute amount.
Absolute value?
Yeah, the EBITDA per ton.
EBITDA per ton?
Yeah.
So it's about 4,500 per ton.
Understood. Thank you. Thank you.
Quarter 4, huh? Quarter 4.
Yeah, understood. Thank you.
Yeah, thanks.
Thank you. The next question is from the line of Sanjay Jain from Motilal Oswal. Please go ahead.
Hi, I missed the volumes you talked about in the beginning. Pig iron sales was how much, sir?
Where? In which month or which quarter?
Fourth quarter.
Quarter 4, the pig iron sales were about 71,000 tons. Compared to 31,000 tons in quarter 4 of last financial year.
Okay. And DI pipes?
DI pipes, 65,000 tons compared to 66,000 tons in quarter 4 of last financial year.
Okay. Okay. So now, if I divide this volume from the ductile iron segmental revenue, the average price has declined from December quarter to March quarter. Is it because of the mix or there is some other play?
On a sequential basis?
Yeah.
On a sequential basis, we sold more percentage of DI. So, it should not have declined. I mean, we can just check the numbers.
Because
as against 50,000 tons of ductile iron pipe, we sold 65,000 tons.
Yeah, so I had this 48,279 punched in my model. Maybe is that the number, or do you 50,000 is a round number you're saying?
50,000 is a round number, but it will be 49 something.
Okay, so
in fact, it is 50,180.
Sales.
Yeah, sales.
Okay. Yeah, then also it should be, why it's declining sequentially? I'm just wondering.
No. So you're talking about the combined, no? Combined EBITDA. You're talking about combined EBITDA, or what are you talking about?
No. See, the segmental revenue from DI is 300 crore. If I divide 300 crore by 65,000 tons, then I get 46,149. Correct? And similarly, if I do that for the December quarter, where the segmental revenue was 242 crores, and you're saying 50,000 tons, and if I divide, that's 48,468. So it's about 2,000 rupees less sequentially. So average price realization. Is it because got something to do with taxes or anything, or there is a price which were lower? Price would have been stable, right? Or could be the mix of product mix.
I just try to explain. The top line is inclusive of the freight.
Sorry?
You're talking about revenue, no? Segment revenue.
Yeah, I'm only talking about revenue.
So segment revenue includes the freight as well.
And it varies from which market you are selling. So if you see the net realization for us, even the gross increase of freight there is a difference. On a net realization, there is almost 300 rupees improve on quarter-on-quarter.
Okay. So it's because of the freight mix.
Both the cases is 38,800 approximately in quarter 3 and quarter 4.
So the NR of ductile iron pipe is more or less the same, but the volume is much more on a sequential quarter basis.
Got it. So this decline you're saying is because of the freight mix. We sold more.
So net realization for us is both the quarter is same.
Okay, got it. You saying that prices of DI pipes have increased. So when going to see the kind of benefit, which quarter, and what is the increase in percentage term?
Yeah, so if you look at on a year-to-year basis, FY17 to FY18, the coke cost went up by 34% for us. The pig iron prices went up by 21%, while the ductile iron pipe prices went up only by 4 to 5%. So while the coke cost was more or less, passed on to the pig iron guys, but on ductile iron pipe we could not pass on. That is why the EBITDA percentage has marginally come down.
Correct. So now what kind of price increase you are expecting?
Yeah, so the reason for that, as I said, was mostly because of GST. There was a slowdown, and there was a lot of confusion. People had stock, so they were desperate to sell and clear up. But now things in Q4 are beginning to get better. The new bookings, etc., that we are doing are at reasonable numbers. I will not say that they have had a major increase, but we are beginning to see some increase, and that should help us. And with raw material prices going down, so the spread should be better as we go forward.
Okay. Thank you very much.
Right. Thanks.
Thank you. The next question is from the line of Mr. Saket Kapoor from Kapoor & Company. Please go ahead.
Yeah. Good afternoon, sir, and thank you for allowing me to ask the question. So firstly, what is our installed capacity as of now in the DI pipe segment?
What profitability?
No, sir, I'm asking about the installed capacity.
Oh, installed capacity. So installed capacity theoretically was about 180,000 tons.
Right, sir.
Okay. Last year in FY17 we did about 186. This year we have sold about 209 or 210, whatever. So we are doing more than the capacity utilization, but then capacity is a bit of a misnomer because it also depends on your product mix and your size mix. So you can play around with the capacity depending on if you can get favorable, product mix from the market. And that's exactly what we have done.
And for pig iron, sir, what is the capacity?
About 3 lakh tons.
3 lakh tons.
Yeah, but what has happened is that 3 lakh tons is that net. So with an yield factor, etc., you will get less than that. Also, the fact that we ran out of our environmental condition limit, for a hot metal, we had to take a shutdown of the plant towards the end of March. And that is otherwise we could have produced more and made some more profits.
Okay, sir. And that would get make up for the first quarter, so that increment, the loss in volume, or that is lost permanently?
That is lost permanently because till in the financial year, we didn't want to, we could not have exceeded our environmental condition limit. So we have already applied about 4 or 5 months back for increasing that, and hopefully that will come through by end of this year.
Okay, sir.
Then we can
yes, sir. We always think that for the pipe manufacturer, Q4 is generally the largest of the quarter, and even due to the GST playing up in the second half, Q4 normally looks good. So, sir, does the seasonality factors play into from Q1 onward now? And Q1 is in comparison a smaller quarter in terms of the deliverables, or are we going to see the continuity in terms of the volumes of pipe to be delivered for the first quarter of FY19?
No, so you're right. Q4 is normally the best quarter, and there are reasons for that. One is, of course, the weather. So more work happens at the site. The other is that the government projects normally have a funding issue beyond the financial year. So the project authorities are also keen to complete. So there is a rush to complete those projects and procure stuff. Beginning of the year, there's always the issue of, funds being released. So 1 or 2 months goes in that. Then there is heat. Work is also less. So you're right. So the first 2 quarters are normally the weaker quarters.
So this will be a dull quarter, sir, on a comparative basis also. If we compare the first quarter for FY last year with this, it will be in the similar line to be a dull quarter itself.
So we don't want to give so we don't want to give a guidance. We don't want to give a guidance. All I can tell you is in all parameters we expect to do better. Because obviously we have taken certain initiatives and we have, so generally things should be better, though because of shutdown, we would lose some production. Because of the weaker quarter, we've also planned some shutdown, both in DIP, pipe plant, as well as in the blast furnace. So one of the furnaces we already took the shutdown. The other furnace we will take shutdown, also we'll plan it in this quarter, and we will announce it at an appropriate time.
Okay, right, sir. So just getting back to what you said, that what is the business environment sense for DI pipe manufacturers, for if we take a vision for 3 years or 5 years down the line? You told that even a fraction of what the government is committing comes into the actual play, then there will be a 10 to 12% growth for the entire DI manufacturing community. So if you could give some more color, how well is this industry placed if we take a vision of 2022 or even beyond that?
So we have taken, we've got some studies done through third parties and some marketing consultants, etc. over the last, 6 to 9 months when we are putting together our long-term growth strategy. We got the study done, and the projections are, in line with what I just told you a little while back, saying that, a 10 to 15% growth is what is looking likely over the next 3 to 5 years. Now, we are trying to get down to the details of which area, which state, which district. So that is the kind of detailing we are trying to do. And therefore, what kind of capacity expansion we should be looking at, growth, whether organic, whether inorganic, whatever. So all that is being kept into mind, but generally the industry the demand is healthy, it's robust, but we also have players who are losing money. And if you do these studies, you will realize there are people who are at 70% capacity utilization also. But then DI pipe industry also requires, a bit of know-how and engineering. It's not a commodity like pig iron purely, both from a product point of view, on the market point of view, as well as the product point of view. So it requires a bit of know-how, quite a bit of know-how and technical understanding. And a lot of companies struggle, on their operational efficiency perspective. So that's where we think we are reasonably placed. And as we go forward, this is where we are focusing on further improving our cost efficiencies, on further looking at automation and digitization are going to be the key mantras for us as we go forward. And how do we differentiate ourselves compared to the rest of the industry is what we are focusing on.
Right. So there are such assets available if you can name in the Electrotherm and the Satwana's type. So have you taken a look at the assets and their alignment with our company, or the study is still left to be done?
So we have been evaluating these over the last 6 to 9 months, even 12 months, I would say. And we have looked at many of these, depending on the valuations, depending on the fitment, and depending on, the attractiveness. We were interested, let's say, if something was available at an attractive valuation. And we continue to look for such opportunities. If we have not announced anything, that means we have not found anything till now, isn't it? Or we are still looking. So what I would say in general is that both organic and inorganic growth options are under the scanner. In fact, I would say that we have gone a long way in terms of putting together our capital governance process and project planning. So hopefully, if things go right and we get all the necessary clearances and tying up of funding, etc., then in the next few months, we would be able to tell you more on this with much more clarity. I also know that I've been saying this over the last 3 to 4 months, but this has not yet happened because of various reasons, because we're also focusing a lot more on ensuring the every detail before we really take the plunge. So let's hope in the next few months we should be able to tell you something.
So for order book, could you share some light?
Sorry to interrupt you, Mr. Kapoor, but maybe...
Yeah, this is done and then I'll let you. For the order book, if you could share some light.
Order book would be roughly about 8 to 9 months as of now. So a healthy order book.
Yeah. I come 9 months. I have 6 to 9 months.
8 to 9 months, yeah.
8 to 9 months. Okay. Thank you, sir.
Right. Thanks.
Thank you. The next question is from the line of Dhiman Kothari from Invesco Mutual Fund. Please go ahead.
Yeah. Good afternoon, sir.
Good afternoon.
So we have been waiting for the CAPEX announcement, and It's like the third con call I've been hearing that we will be announcing the capex very soon. So where is that deterrent? Are there any deterrents per se?
No. So as I was saying a while back, that, for example, if you look at it and if you go and check, we have, we are already in the process of taking some statutory clearances. Some are already available publicly.
Okay.
But the statutory clearances take some time. Okay. So there is land acquisition, there is environmental clearance, there are, things like that. There is tying up of funding, etc.
Okay.
So, moment these are, at a stage where we are very confident of announcement, we would announce it. We don't want to announce it, make a premature announcement unless some of these things are extremely clear. So we don't see a reason why they will not be clear, but it's just that, we are also, as I said, to ensure that the new plant is much better than the older plant.
Okay.
We're also taking help of some foreign consultants.
Okay.
And there are some studies and reports which are being prepared. So that is why this got a bit, I would say, delayed in some sense. Otherwise, we could have done it maybe a little earlier than what I'm talking about.
Okay, but at least any sense you could provide whether you are looking at brownfield or a greenfield, or that is also not possible for you to share as of now?
No, I said I'm looking at both.
Okay.
Organic as well as inorganic, both. Both
No, not inorganic. Greenfield or a brownfield?
No. So you are saying you're talking about greenfield. No. Greenfield is not something which we are looking at. Right.
Okay.
It has to be either brownfield or an M&A or an acquisition, or whatever. So these are the only options left. We are evaluating all options. I can only tell you that we are at reasonably high advanced levels.
Okay.
But which one we will finally take a call on also depends on, a few factors, which is what we are trying to tie up. And certainly we will have something to announce in the next few months. So I know about the fact that we have not been able to do so. And there are
because
the outlook,
because the outlook you have provided on the industry, it seems that there's a huge opportunity loss you would be having if you are not getting the capacities ready on time.
Yeah, but what happens is that you can announce and then spend that extra time in doing some of the statutory clearances, etc.
Okay.
What we are doing is doing those clearances first, making sure that we don't get stuck later and then announce.
Okay.
That's the difference.
Fair enough. Okay. Yep. Yeah. Thank you.
Right, thanks.
Thank you. The next question is from the line of Srimant Dudodia from Unified Capital. Please go ahead.
Yeah, good evening and thanks for the opportunity. So the first question is, you mentioned that you try to debottleneck your existing capacity to increase the volumes. So what is the incremental capacity that could come in because of this debottlenecking?
Yeah, so incremental capacity could be anything, say, let's say, it could be 5 to 10%.
Okay.
Incremental cannot be, very significantly higher. We will obviously try for more, but that's what we are aiming for.
Sure. So this would be both at the pig iron as well as the DI?
Yeah.
Got it. So secondly, you mentioned in the initial remarks that you have started to hedge your raw material cost as per your finished goods pricing. So if you could detail a bit on, this, what kind of hedging? Is it going to be 100% of your finished goods would be, the raw material required for that would be hedged, or if you can detail what is the strategy in this?
Yeah, so the strategy, as I explained to you, was that, you are today dependent upon the volatility in raw material prices impact your profitability, and to that extent you are blind. You don't know because raw material prices are not in your control. Of course, neither are the finished good prices, but the fluctuations in raw materials much more. So,
Hello?
So, and coke in turn is impacted by coal price as well as the demand of coke. So both these fluctuate and impact ultimately the cost of any pig iron producer. What we have done is we have to tied up and we have been able to link, to some extent control 80% of our coke, 80-85% of our coke buying by going in for either captive or long-term. The long-term part is linked more.
Hello. Hello.
Are you able to hear me?
There was, I think, the line got disconnected in between.
Is it? So I said that we are, we are able to control the coke volatilities to a large extent by doing either captive or long-term basis coal pricing mostly. So therefore, we have to go to the next. I said that we will begin to do some hedging from this quarter onwards. We have not yet done it, but we will begin to do that and link it to our finished goods prices to some for a certain percentage. Obviously, we don't want to do 100% because we are new in this game and we would want to learn and as we go forward. But it's clear that if you link it to your finished goods, at least you are able to predict your profits. Right now, you book an order for ductile iron pipe which is open for next 6 months, but for the next 6 months your coal prices are volatile. So it can either go up or it can go down, over which you don't have control. So that is the strategy of first controlling coke, then going down to coal.
Okay.
I hope I've been able to make myself clearer.
Yes, I got that. Thanks.
Yeah.
Was there any one-off extraordinary in the other expenses in the quarter?
Yeah. So, Shubhro, our CFO, he will tell you. Shubhro, you want to talk?
Yeah, in the other income, there is a one-time gain. We have got a long old outstanding of the capital creditors of 9 crore, which is no longer payable. That we have taken back of 9 crore in the quarter. So that is a one-time gain of quarter 4.
Yeah. On the other expenses as well, was there any one-off?
Other expenses, there is no one-off. If you see, the volumes have substantially increased.
Yeah.
Both DIP as well as DIP production and sales.
Mm-hmm.
So therefore, the stores consumption and the conversion cost, absolute conversion cost have gone up for the DIP, for the volume. As the freight, we have sold more, the freight has gone up. There is a one-time of 2.5 crore approximate, which we have spent for the spend in quarter 4 for blast furnace 1 shutdown.
I had mentioned to you that we had to take shutdown because of the environmental condition limit. That shutdown was earlier planned in FY19. Okay. So therefore, there is a one-time expense on account of shutdown of 2.5 crores.
Got that. So you also planning to take a shutdown in the current quarter, that is Q1 19. The duration of the shutdown would be similar as in the last quarter, or is it different?
Yeah, so that's the other blast furnace, plus the pipe plant also. Both these shutdowns we are planning, but we will announce it. We will let you know. Shutdown should be similar. Blast furnace shutdown should be similar, but we'll announce it because we also have to notify, the stock exchanges. So we'll let you know once we have formed it up.
Sure. Thank you, sir. All the best.
Yeah, thanks.
Thank you. Next question is from the line of Yogansh Jiswani, who's an individual investor. Please go ahead.
Hi. Thanks for the opportunity, sir. I missed out on the other income reversal that you said. Was it for 5 crore, you said? Hello?
We could not get your question. Sorry, can you repeat?
Other income? The other income part you shared, I missed out on the figure. Did you say 5 crore reversal we got?
9 crores.
9 crores.
9 crores.
And this reversal is in what regard, sir?
This for old capital creditors liability, disputed of $1.35 million, which is no more payable by us. So we have reversed the liability and booked as our income.
Okay, understood. And sir, okay. And sir, secondly, you said you have an order book of almost 8 to 9 months. So, is it possible to quantify this order book in terms of how many crore orders is it?
I don't have the number in front of me, but I don't think that's really extremely important. 8 months, so take about 8 months on an average. I'm just giving an approximate number. So in 12 months, if you are selling, say, 200,000, if you take this year's figure, 290, take 200. You can just divide it and you will know what is the order book in terms of volume. As far as prices are concerned, these are coming from various states, so rupees crores, I don't have it readily with me. And I don't think it will matter too much because prices are more or less average realizations you already know.
Fair enough. And sir, lastly, I would like you to share your vision. Like in past, we have seen throughout our history that pig iron has been a very volatile business segment, whereas DI pipe is a much more sustainable or kind of a niche segment, and hence we started moving from pig iron towards DI pipe. So now that you're talking about these growth or options that you're looking at, capex options you're looking at, so should we consider it as a next step ahead in terms of moving towards a much more sustainable business model and moving away from commodities like pig iron? So is it on those lines, or what's your vision going forward for a sustainable or a stable business?
Yeah, so you're right. Obviously, the ductile pipe business is an attractive market today. And that's how we foresee that for the next 3 to 5 years at least. And that's where we have been steadily moving. Today we are, more than 50% of our sales is coming from ductile iron pipe. And year on year it has been going up, except for FY17, where, the ductile iron pipe as a percentage of revenue was almost 60%. But that's because we had taken a shutdown for 3 months for revamping our blast furnace, so the volumes were not available for sale. Now we have come back to a normal, and therefore, as a percentage, as we grow, it will be more in the pipe business and less in the others. So that is an obvious one, and that's what we are pursuing at the moment.
Fair enough, understood. And so, last quarter con call you mentioned about that we had taken a lot of activities like some sinter plant and similar such activities which would help us in bringing down cost pressures or improving our efficiency. So, are those benefits visible in Q4, or are they still to be seen in coming quarters? Just your thoughts or comments on that.
Yeah, so we had taken up some cost, efficiency projects. And as a continuous improvement, as part of our continuous improvement or business excellence initiatives, which we had launched about 6 months back. And we have seen clear benefits arising out of that because we are focusing a lot on the cost leadership front. Because in a commodity business, I think that's where if we focus more, the benefits are likely to be more. So one is on the cost leadership side. So benefits have already started coming in, and there are projects which are taken up. These are reviewed every week by the relevant vice president, and monthly I review them. So we ensure that these projects get the necessary support. Once we see that it's very clearly quantified in terms of the benefits, then the same are pursued till the results are out. There are very simple things which will improve the cost efficiency. For example, oxygen. Simply the level of oxygen that you put in the blast furnace, if you increase that and up to a certain percentage, your productivity goes up. We are well below that optimum percentage. So what we did is we took a project and we got liquid oxygen since our oxygen supplies were limited, and we tied up with one of the major oxygen suppliers of the country, and he's supplying now liquid oxygen to us, and that's helping our production. So we can see a day-to-day improvement. Similarly, look at structural cost improvement, the PCI project, the pulverized coal injection project, which is on track to come up by end of the year. That will replace coke 1:1, and the difference in cost between the two is almost 10, 12, 14,000 rupees per ton. So straight benefit to the bottom line. So focusing on some things like that, how we can use more of agglomerate, more of sinter percentage, buy pellet and use them. So there are very basic, how do you increase the temperature in the furnace. So there are various initiatives which are on currently, because while on the ductile iron pipe business, our operational efficiencies are of the highest order. On the blast furnace side, we need to improve quite a bit. Although we have improved, but we need to go up the ladder. That's where we are focusing to extract more benefits and reduce our costs.
That's really encouraging, sir. Thanks for sharing your thoughts. That's it from my side. All the best.
Thank you. The next question is from the line of Chintan Sheth from Samiksha Capital. Please go ahead.
Thanks for taking my question, sir. On the industry side, how do you see the demand is coming from a new projects like irrigation and water projects, or are we seeing replacement demand of older CI pipelines getting replaced by DI pipes? So if you can break up or give a color on how the demand is shaping up between the new projects and replacement of older CI lines.
So most of the projects that have been announced by the government are all new projects.
Right, okay.
And they're mostly in water and some in irrigation.
Correct.
So I would say a blend would be more like, 80-20 or 70-30, more on the water side, little bit on sanitation, sewage, and then rest on irrigation. Irrigation would be more like 15-20% or even lower. Okay.
Oh, okay.
That's the kind of mix we're talking about.
Right. And so what is the life of DI pipes generally? How frequently or how long it can continue to perform the activity? Like, is 20 years we have to replace or more than that?
So DI pipe industry in general claims the life is 100 years.
Okay.
But typical projects of governments are for 30 years.
Right. So next...
They will count for replacement after 30 years.
After
Unless
30 years.
The quality is a problem, and which there are suppliers whose qualities are suspect and leakages happen, so they may need to kind of replace them earlier. So that's why I was saying on the ductile iron pipe, there is a lot of technical know-how and understanding which is lacking today with some of the players. There are, of course, some good players, and there are not so good players, which happens in every industry, I would imagine. So, but if you are talking about on the pig iron side, the technical know-how and understanding requirement is lower, relatively speaking, I'm saying.
Right.
Pig iron side. But on the ductile iron side, that's much more of an engineering and technological product than a simple, as they call it, the tor steel or the rebar. It's not a simple process. It's quite a challenge to make, and optimize it. More importantly, you can make it, but at what cost? So that's the difference. So ductile iron pipe requires a lot of knowledge and understanding, and that's where the industry has to grow. So there are big players in the world, but India is one of the large manufacturers of DI pipes. China is, of course, the largest.
Right. So, and again, in terms of replacement or any of the piping solution which can replace DI, plastics like HDAP or composite pipes do have that kind of strength or pressure handling capacity compared to DI, or are we having, or we know about anybody introducing such kind of replaceable DI replaceable pipes solution?
Yeah, for smaller sizes, typically the DI pipe industry competes with, HDPE.
Okay.
And on the larger sizes, it competes with steel, carbon steel.
Okay.
Middle segment, there is hardly any competition.
Okay. And how the cost differential would be, in your view, between
compared to steel, we are much cheaper, although we would like to be more expensive and better priced than steel.
Right.
But on the pipe side, on the lower sections, HDP is much cheaper, maybe 30% cheaper or more.
Okay. And that segment demand right now would be lower because most of the demand you are seeing is from irrigation and sanitation, which requires a relatively larger diameter pipes.
Yeah, so typically the demand say about 15-20%, then there would be the mid-size, and then there would be the large dia. But in the smaller size, say 15-20%, what happens is that HDP does compete very well from a price perspective, but from an environment perspective, from a life perspective, I think the government would like to have more of ductile than HDP.
Okay.
Obviously, the lower costs help them, but with oil prices going well.
Hello. Hello?
Yeah, okay, you got it?
Just missed your commentary because the line got muted somehow.
Oh, is it? No, I said on the lower side, your HDP is cheaper, so it would depend, but say roughly say 30% cheaper.
Correct.
But then the government would prefer, a more environment-friendly and longer life and leak-proof. So see, HDP, what happens, there are rodents which damage it. There are, it can get damaged more easily. This is stronger, life is longer, environmentally more friendly, but more costly.
Correct.
So that's where the issue is.
Okay, sir, on the bookkeeping side, your volume for full year, pig iron is around 290. Can you provide the last year figure, FY17 full year?
For pig iron?
Pig iron.
Pig iron last year was, I think, 190, no? 199. 195.
195,000. And for DI pipes?
DI pipe last year was 186 and this year is 209.
186 and 209. Okay. Okay, sir. Thank you. Thanks.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Mr. Abhisar Jain from Centrum Broking for closing comments.
Sir, thank you so much for answering all the questions, and you can make your final comments before we close the call, sir.
Yeah, so I think I've already said what I had to, but I just wanted to thank you, Abhishar and the Centrum team for organizing this. The performance has been, I would say, quite satisfying in FY18 despite the hurdles we faced, both on the raw material prices side and the GST side. Going into FY19, we are, I think, well placed, and a strong focus is being given on the cost side. There are, of course, concerns on growth, which I understand and take it very positively from the investors. But let me reassure them that we are quite conscious of this and are working assiduously to ensure that before making any announcements, we are clear in what we are doing in terms of all clearances and everything else. We also have plans of both organic and inorganic and are pursuing both. And I can tell you with confidence that we are at reasonable levels at both places, reasonably advanced levels. We'll have to take some calls, and depending on our board approvals, etc., we would be in a position to tell you sooner than later. That sooner, how quickly, I can't tell you, but maybe in the next 2-3 months, 4 months, certainly we should have clarity. So with this, I would like to close. Thank you very much.
Thank you so much, sir. Thanks a lot. Operator, we can please close the call now.
Sure. Thank you very much.